Welcome to Fonterra's 2015 interim result broadcast. I'm Grant Walker. With me, Chairman John Wilson, CEO Theo Spierings, CFO Lukas Paravicini, and Chairman of the Shareholders Council Ian Brown. Well, as you know, it's been a tough year for farmers. So, John, how is it halfway through?
It has been a tough year for our farmers, and there's two things that I know our farmers will be wanting to know today. We want to know what the farm gate milk price is going to be this year and what our dividend announcement is. Firstly, on farm gate milk price, we are holding our current forecast at $4.70. Our interim dividend that we are paying will be 10 cents. Our forecast for the year, we've actually lowered that forecast to 20 to 30 cent dividend range based on our policy of 65 to 75% of net profit after tax being paid to our farmers. Now that will be a surprise to our farmers, and so today we need to go through what has caused that drop from 25 to 35 cents to 20 to 30 cents for our range, which lowers our forecast payout for the year to $4.90 to $5.
So what are those half-year numbers telling us?
So first of all, it's a very tough trading environment out there globally in the dairy market. And that's created by a lot of the milk. We've got an oversupply of milk globally, but also some major geopolitical factors which have had an impact, which we've been talking to our farmers for the last 3 or 4 months about. Importantly, we've got some realities of accounting treatment, and Lukas will go through that shortly. So last year we had a milk price of $8.40, record milk price. That therefore has an impact on our inventory. So for the first quarter of this year, we've been selling product in the market and we haven't been able to recover that milk price that we went in with. That's a reality, and there's some other accounting impacts as well. But most importantly, as I touched on, it is a tough trading environment, and we as a business need to respond to that, and we are responding.
Yeah, what John's explaining, I mean, the first quarter, you start the year with inventory. We had about 200,000 tons of product in inventory, and about 50,000 tons of that inventory was produced in the period between May and July, and that was on still a quite high price level. And what John is saying is that first batch of powder which we sold into the market was really going at a negative gross margin, and that has in the first quarter really impacted our results by 182 million, which is a massive blow in the first quarter. In the second quarter, that recovered, and for ingredients, we still ran a reasonable half year. I will come back on that later on, but the first quarter was 182 million instant impact based on inventory.
Well, before we talk about profit, let's look at production on farm. And the dry conditions didn't help, did they, John? We
started the year very well, so we were 4% ahead at the end of November. Had a higher peak again and a longer peak, and that has an impact on our cooperative as well. But then, of course, the dry conditions started to kick in, and across most of the country this year, there's been some real challenges on farm. Our current forecast is that we'll be approximately, and it's still hard to tell based on, as we as farmers know, based on what happens over the balance of the year, but our current view is that we'll probably end the year about 2% down on last year.
Well, Ian, bringing you in, how have farmers responded to those conditions?
Yeah, Grant, look, it has been, as John has said, it has been really quite a tough year, especially in the latter half post-Christmas. What's really happened, though, is that there has been some rain, and some of our farms and farmers have continued to milk, albeit with reduced numbers and in a lot of cases on once a day. Although there is a fair chunk of our farmers that are very dry, and they are currently drying off their herds as we speak now. March is traditionally a time where we actually start to look forward to next year. And some of those farms are, let's not make any mistake, are in quite a serious position in terms of winter feed. So they need to take that decision now in order to preserve cow condition and ensure they can get their cows through the winter and have a really good start to next year.
Well, John, where do our farmers sit in relation to farmers around the world?
So we've seen the response from our farmers last year with a high milk price. Milk production went up. We also had a reasonable season generally across the country. But that was a phenomenon actually felt across much of the world's key dairying regions. So we've had a high price globally over the last calendar year, and we've had reasonably good production conditions in those countries. And so we've seen overproduction based on relative to the last few years. The reality of that is that price has come down, and unfortunately that price has come down to unsustainable levels, and we're starting to see that bounce around now. So the GDT price, which all of us as farmers see every 2 weeks. Got down to a 5-year low in December. We've since seen it come up significantly, but now there's still a lot of volatility in that price. That's been challenging, and that will continue to challenge the business, and Lukas and Theo will go through that in a moment. On the positive, there is a little bit of a positive here. We've seen our exchange rate come back, and that exchange rate coming back over this financial year, so far through the year, is having a positive impact of around about 30 cents per kilogram of milk solids to our farmers, which flows through in that milk price. So while we've had lowering global commodity prices, we have had a slightly positive impact by the exchange rate coming down and our treasury teams being able to capture that benefit.
All right, Theo, let's now dig into those numbers.
Yeah, and I think to connect to what John just said, we have to remember that global dairy trade is our base. Yeah, that's our starting point. And with global dairy trade, that's not a spot market, but it's almost a spot market. So we move up first, and we peak highest, and we move down first, and we peak lowest, or we bottom out lowest. So last year, the 850, we were actually, on your question, we were paying better returns to farmers, or higher milk price than the Europeans paid. And now when you go, what John's saying, down so fast, and you dip deeper, then you find yourself in a situation where we're in right now, or the first half. But going to the key numbers, milk volumes off farm have been very good. Or the start of the season was really good. Ian was talking about the drought right now, but first half really good, and that reflects in our numbers. If you look at the key slide now showing up, volumes up to 2.2 billion kg. That's about 10% up. I've just explained for ingredients that we had a very, very poor start first quarter because of the 182 million impact. Still, ingredients did 299 million for the half year. Yeah, there was 2% up. And our consumer business, Lukas will come back on it, we had quite a significant impact in Australia of about 100 million, but consumer business also is up 23%. In our international farming business, especially in China, we had a revaluation of our herd because of the lower milk prices, and that led to a 27 negative result. But overall, if you look at the key drivers of our business, ingredients, given the weak first quarter, strong, and consumer also pretty strong, considering what Lukas is going to talk about in the impact in Australia.
All right, well, Lukas, I want to bring you in at this point. We've not often talked about results in international farming before. Why now?
Yeah, that's right. And I think it's important that farmer shareholder can see that we listen to them and that we strive to improve our reporting constantly. And what we want is the farmer to be able to follow the money. And what we have done this year is actually to align our reporting to the strategic platform, which are ingredients, which are consumer and food service, and international farming. And that's why we have separated international farming also outside China, so we have a clear view and a better transparency on how our different platforms deliver their results.
Ian, I want to bring you in at this point. Well, Fonterra holding farmgate milk price, the forecast reduced to 20 to 30 cents for the dividend. So the forecast cash payout now range of $4.90 to $5. It's not what farmers were expecting.
No, you're right, Grant. Farmers understand the milk price side of the equation. Theo touched on GDT, and there's some real transparency around the drivers behind the milk price, and our farmers understand that. I think farmers will be really disappointed with the dividend. There would be an expectation in a year with a low milk price that there would be a compensatory effect with the dividend. That hasn't happened, and the reality is that our farmers, would like to see their investment in the co-op deliver.
We'll talk about that soon, but Theo, first of all, let's go through the results for different parts of the business.
Yeah, let's start with ingredients, and that's it started off, if you compare half year with half year, but in a world where prices are so volatile, it's difficult to compare. You see huge swings in margin and prices. This chart shows that last year we ran an EBIT result of 292 million in ingredients. The 182 million I've spoken about, there was inventory value on a high milk price. If you consider that to be not there, then your result would have been almost $500 million here, but that's not the case. We had to sell this at below gross margin. But you see that the 253 million was taken out of market, and on top of that, price premiums for our products, because we are based in New Zealand, that we can really ask for premiums. Then in ingredients, the Australian side with a high milk price, and relatively low commodity prices, a negative of 84 million. And these are kind of the big steps in ingredients, which bring us to a 299 million EBIT for the first 6 months. But you see, it's massive movements.
Well, Lukas, let's talk about ingredients. What's being done to improve ingredients performance?
I think it's important that we highlight the levers we have in the ingredients business to drive performance. Clearly, we will continue to strive to increase our price premiums. That is, the services we can offer to our customers for them to pay a premium beyond and above GDT. We have a strict target on that and will pursue that relentlessly. But we also can invest further in our capacity to make sure that we have the best possible position to take advantage of the best product mix that we can produce to, but also to increase our efficiency in the plants. If you take Darfield or Litchfield or even Payatua in the future, they are bigger, more efficient plants and will therefore also reduce the production cost and therefore increase milk price over time. But really, if we want to fix the business in ingredients this year, the impact in Australia has been significant. It is a product mix issue, and therefore it is absolutely important and key that we accelerate the alignment of our Australian product mix to the multi-hub strategy. And there is a big opportunity by doing that in Australia.
Well, how was performance in consumer and food service then?
Consumer and food service business has actually done well. We have increased to $160 million the EBIT, 23% increase over last year. We can do more and we want to do more, but this performance has been driven by volume increase, but also price increase in the strategic markets, which is good news. We have had an offset of that performance mainly through cost that came through Latin America to some extent in Australia. And I think that it's important. While this is not acceptable, it is true that those pools are not related to the New Zealand milk price and therefore have slightly a different dynamic. Whereas last year, they have helped us to maintain a good performance in the first half. This year, they were lagging behind, and that has taken a toll on this year's result. You can see also that the second quarter was much better in those consumer businesses, and we expect this to go on into the third and fourth quarter.
You've been focused on turning Australia around. How has that been going for you?
We have made progress, but at the same token, let's be honest, we have a lot to do still in Australia. On the good side, we have significantly improved our relationship with the retailers, especially with Coles, but also in terms of DIFOT, we have brought it up to good standards or very good standards. We also have done very good business in terms of our chilled spreads, but also our cheese. The issue we are still facing is our mainstream yogurt business, taking Tamar Valley as an exception, which is a specialty which is doing very well, but our mainstream yogurt is of concern, and we will address it in the future to make sure that we turn Australia around completely.
Theo, international farming, a new result here. Can you take us through those results?
Yep. International farming is mainly China, our China farms. We really have put out that we are going to have 1 billion liters of milk. It's ramping up. So we have almost two hubs completed. Yeah, 2 hubs means normally 10 farms. We have 9 farms completed. We have about 24,000 cows in production and 25,000 heifers. And that's what you see in the results as well. I mean, we have done operationally quite well, although the milk price in China also fell back because of the international prices. So definitely pressure from way above 5 RMB to 4.5 and even below. So there has been pressure on milk price. We have done extremely well with the cows in production when it comes to feed cost. Yeah, so our gross margin has improved. Our overheads have gone down. But you're having cows, or still quite a number of cows, who are not in production but still consume feed, right? So That's why you see on this chart, we had a cost impact, but that's new cows or new animal pipeline flowing in. And of course, you're building up your farm, so you have cost, which you only recover later. But the biggest impact here is the 17 million, because the milk price dropped in China as well. The milk price is related to the value of the herd. Yes, the herd gets revalued, and because the milk price is lower, there's more aspects, but that's the main driver. We see a 17 million impact of the herd, which is really an accounting issue. It's not an operational issue.
Well, John, earlier you talked about farmers looking out towards year end, so how is the outlook?
Yeah, just before I get on to that, Grant, just to follow on the comments that have been made by Lukas and Theo, one of the things that's important here is that the slides that are going up in front of our farmers are very much this year relative to last year. Last year we did make that adjustment in the milk price. This year we've certainly got no intention of doing that or see no requirement to. So that does make that a little bit odd this year versus last year. And the other thing for our farmers, and we know this over time, that the first half year is always quite difficult to tell because of all the realities that have been talked about today, particularly those inventory type impacts and accounting features that have been talked about, which is really frustrating for us as farmers. Back to your point, that $4.70 is our milk price forecast for the current year. As we all know, we're looking at GDT every 2 weeks as farmers. There's still a lot of volatility. So I'd really ask that farmers maintain significant caution as they continue to set their budgets for what is the balance of a tough year. Unfortunately, we have had to bring down our forecast dividend for the year to that 20 to 30 cents range based on that 65 to 75% dividend policy that we've talked about earlier on. Now, we know that this is a very tough year for our farmers, and Ian absolutely spot on in what he said earlier. You know, our farmers expect over time that when that milk price drops down that you will get a higher dividend. But there's been, as has been touched on, some extraordinary difficulty in trading in the market globally. It's a bitter pill for our farmers to have to swallow, particularly on the back of a difficult trading year. But you know, our farmers understand what is happening globally, and we'll be out and obviously talking about this, which we'll come to shortly, to our farmers.
Well, Theo, shareholders are looking for results. How are you going to deliver it?
It's very difficult on a day like this to talk about a journey because nobody wants to talk about a journey. But if you look at the co-op and you look at the huge volatility around the world, you have to keep your eye on the ball. What's the long-term perspective? And I do believe that with our strategy, but also with our vision on what Lukas touched upon, the multi-hub strategy which we approved, which our farmers understand, we are uniquely placed to build that globally relevant co-op. And that's all beautiful words in a time when there's pressure. It's disappointing when you have the outlook which John has just explained. But in farmer language, talk about revenue line, cost and cash. On cost and on cash, we're doing very well year on year. Cost we can contain. We have really leveled out. We have not even seen cost increases inflation based. It's really flatlined. On working capital and cash, we have done a tremendous job. We have really brought home a lot of money from inventory and working capital. Where we lack is on the top line development, turning the wheel, volume to value, and that must go much faster and much more volume to value because that generates gross margin, and that money with your cost structure is straight in the pocket. And so that's where we have to go harder, and that's where I'm also chasing and disappointed, and that's why we have discussed that. We really need to have some transformational thinking, entrepreneurial thinking on the top line development. How do we drive more volume to higher value faster? Right? On cost and cash we have done a good job, but on the top line development we need to improve.
Theo, can you expand on your reference to entrepreneurial? What do you mean?
Entrepreneurial really comes with our strategic journey, and what I really mean with that is not so much revolution, or it's more evolution on the transition, transformation of our thinking, that it is sales volumes up, maximizing gross margin, cost and complexity as much as possible out, and really thinking twice what you do with your capital spent. That cash flow is really at the highest possible level. That's entrepreneurial thinking for me.
One thing you've done is you've lifted the pace of investment in this country?
In the country, yes, but people think that we invest in the multi-hub strategy and that all the money goes offshore. Actually, that's not the case. If you look at the last 3 years, 75% to 80% of the money invested is in New Zealand, and we have really invested from 10 years ago we were even at 7.5 ton dryers per hour. Then we went to 13. Then we stepped up to 27, and now we are the world, or unique in the world, running 30-ton dryers. And these cost a lot of money, like Darfield, now Litchfield, Payatua. So we have invested a lot, what Lukas also said, in optionality, creating optionality. But we also invest in our partnerships offshore. But that's more partnership driven. That's not so much capital expenditure. That's the partnerships with the Dairy Crest of the world, with Aware in the Netherlands. Yes, that's a capex. And you've seen us last week confirming the deal with Being Made. So offshore it's more partnerships. At home it's much more capacity, stainless steel, making an infrastructure for farmers to grow.
Well, Ian, I'd like to ask you, how comfortable are farmers right now with the level of investment in New Zealand?
I think farmers understand the need for investment in New Zealand very well. Our farmers have grown something like 3.2 billion litres in the last 5 years, so that milk's got to be processed somewhere. They also understand the realities of the constraints that we have at the peak around product choice and the cost to that to us as farmers as well. But what they really want, I think, on top of that, is a return on their investment is key. They love, and I'm speaking from experience here because I do have some significant investment in my area at Litchfield, so I'm quite proud of that. However, when you do drive past it, it does come at a cost, and and that cost is borne by farmers. So they rightly should be concerned enough to turn up to our meetings next week, ask some questions, get a greater understanding of what these results mean, and more importantly, what the future is going to look like heading out.
John, let's talk about those meetings next week. You'll be wanting a good turnout?
Yes, we will, and we expect a good turnout. And certainly in the meetings, Grant, there will be ample time for our farmers to have good discussion and go through the points that have been raised here by the team. But I tell you what, when I put my farmer's hat on and I think very much about where we are, and we've all been doing that a lot of late as we've been operating in this difficult trading environment, and also with this absolutely appalling situation with 1080. Just thank goodness we do have Fonterra. And as a farmer, and Ian's touched on it, and what we expect from our cooperative is the transparency that we drive, is this absolute commitment every day to maximise the total payout to our farmers. And what we are seeing is we've seen a few others sort of enter our New Zealand marketplace, and that rightly is creating a little bit of unease and discussion with our farmers. So again, I hope that our farmers come along to the meetings and discuss that, because what we see is a cooperative that's absolutely committed to transparency, that's absolutely committed to maximising their payout for our farmers every single day of the week. We have global scale, we have transparency through GDT, we have the strategy which is being driven here. And what we're seeing is the strategy is right, the vision is right, and it's our ability to be able to constantly change to these market conditions. So I really hope that our farmers come along and discuss the value of our cooperative over the next week.
Thank you, John, Theo, Lukas, Ian, and thank you for watching. We look forward to seeing you next week at the meetings.